Welcome back to Invest and Talk podcast.
Today we are really unpacking the infrastructure story behind the entire AI boom.
And we're focusing on one company in particular, SanDisk, ticker SNDK.
That's right. If you think of AI models as these new, massive brains, SanDisk is essentially the memory.
The memory that holds all their data, their experiences.
Exactly. This is a pure play leader right in the middle of the NAND flash memory market. And it's just riding this enormous wave of AI infrastructure spending.
And the market has definitely noticed. I mean, the numbers here are almost hard to believe.
They are.
This stock has rallied nearly 1,000%, a 948% jump since its spinoff. That's just historic growth.
It is.
But here's the mission of our analysis for you today. Even after that incredible run, our work suggests it could still have potentially a 50+% upside from here.
And we're going to unpack why. Why is this company still in such a sweet spot? And maybe more importantly, can it actually justify that breathtaking valuation?
As usual, before we start, subscribe, like, and comment to support the show and help us bring you more analysis like this. Okay, let's unpack this and start with the core numbers.
Yeah.
When you see a rally that huge, the fundamentals, they just have to be bulletproof. So Q1 2026, what did it look like?
Q1 was, it was exceptional. It shows the growth is real. It's driven by actual demand, not just hype.
Okay, so what was the revenue number?
SanDisk reported $2.31 billion in revenue,
Right.
which is a 22% jump year over year. And it significantly beat the consensus estimates. They were around $2.12 billion.
So that top line is really strong, but earnings, that's where you sometimes see the games.
Right.
The EPS came in at $1.22. I saw that, and it just blew past the consensus of, what, around 58 cents?
Yeah, that's a 58.44% surprise. It's huge.
Yeah. So where did that come from? Was it just pricing power in a tight market?
It was a mix, but yeah, leaning heavily on pricing power and just strong operational leverage. The analysts had clearly underestimated them.
And what's that mean going forward?
It gives us really crucial forward visibility. Management's guidance for Q2 was incredibly strong. They're projecting EPS between $3 and $3.40.
$3 to $3.40 from $1.22.
I know. That massive step up is all about AI demand just accelerating everything.
Okay, with a manufacturer like this, I always go straight to the balance sheet.
Good call.
They have to spend so much money to stay ahead, and liquidity here looks incredibly strong. I'm seeing a current ratio of 3.29, quick ratio of 2.03.
And that's a great point. For business like this, cash is everything. They're constantly investing in new fabs, in R&D.
So that 3.29 number means they have plenty of cushion, right?
Plenty. Over $3 in liquid assets for every dollar of short-term debt. It lets them reinvest without, taking on mountains of new debt. And their leverage is minimal. Debt to equity is just 0.14.
And that financial health lets them push forward on their tech. You mentioned buy CS8.
Exactly. That's the key.
So let's talk about that tech. What is the actual moat here? How is buy CS8 different from what Samsung or Micron are doing?
Okay, so the core moat is their leadership in 3D NAND SSDs. And buy CS8, it's not just a small step up, it's a huge differentiator for AI.
How so?
Think about it like this. These huge AI models need massive data lakes. Petabytes of information that have to be fed really, really fast to the HBM memory that, say, NVIDIA uses for the actual processing.
So the HBM is the race car engine,
Right.
and buy CS8 is like the giant, super efficient fuel tank that feeds it.
That's a perfect analogy. It maximizes density, so more storage and less space, and it cuts down the latency. And for their big data center customers, the switching costs are, they're extremely high once you're integrated.
And what's interesting is how their competition is almost helping them.
It's fascinating, right? Samsung and Micron are so focused on HBM production that it's creating this supply crunch across the whole memory sector.
So SanDisk benefits because its rivals are pushing up prices by almost 20% while focusing on a different product. That's a pretty clever defensive spot to be in.
It is. Now let's pivot to the charts and see how the market is translating those incredible fundamentals into price action.
Yeah, the technical picture is just as explosive.
It really is.
Explosive is the word. Shares were recently around $392.50, which is just knocking on the door of the 52-week high of $401.20.
So close.
That 948% rally is a massive breakout. But let me be the skeptic here. A chart that steep, it screams froth to me. What tells you this isn't just FOMO?
Well, the structure of the rally is key. It's constantly clearing these psychological resistance levels because the money flow is just relentless.
We're talking about institutional money.
Yes, sustained institutional buying. The stock's up 64% just this year alone. But the most telling signal for me is the bearish positioning.
How far have the bears backed off?
Short interest has actually declined by 3.0%. It's now at about 7.43% of the float.
Which is significant.
Very significant.
Yeah.
It means the short sellers are capitulating. They're giving up because fighting this AI storage narrative is just too expensive.
And then there's the options flow, which gives us a clue about the more speculative money.
Right, and that remains moderately bullish. We're seeing call volume outweighing puts, which shows conviction for more near-term upside. But you have to acknowledge the volatility. It's baked in. Implied volatility is high, suggesting the market is expecting a daily move of maybe $26.92. This is a high-octane stock.
No kidding. So moving beyond the charts, what is the street actually saying about SanDisk right now?
The quantitative scoring is overwhelmingly positive. Ticker sentiment is averaging around 0.60 bullish across the news feeds.
So the narrative is positive?
Very. In fact, if you look at the last 5 relevant articles, all 5 confirm that strongly bullish mood. The institutions are behind it.
Okay, let's dig into the analysts. We're seeing some absolutely wild price targets. Sanford Bernstein has a $580 target.
Astonishing, right?
And benchmark is at $450, up from $260. Why should we trust these high-end targets when the average on the street is still down around $380?
Well, that gap, that discrepancy, is exactly where the opportunity is, right? The overall consensus is still a moderate buy.
So the bulls are way ahead of the consensus.
Exactly. The analysts setting those $580 targets are betting on a multi-year re-rating. They believe Q1 was just the start, and they're applying a much higher growth multiple based on that buy CS8 adoption curve.
That makes sense. And what about the smart money? Are big institutions actually putting their money where their mouth is?
Absolutely. We're seeing major accumulation. RWC Asset Management started a new $6.89 million position.
Okay.
And even more telling, the Virginia Retirement Systems put in $4.05 million. That's patient, systematic money. They're investing in the long-term reality here.
We should probably also touch on some of the speculative factors that are fueling this.
For sure. There are these unconfirmed rumors about AI storage prices hiking even faster than people think, and potential NAND shortages because of new platforms like NVIDIA's Vera Rubin GPU.
All feeding the bullish narrative.
Totally. And then you have the high-caliber board appointment of Alexander R. Bradley, which just signals they're serious about managing all of this growth.
Yeah.
Now, we've covered the overwhelming bull case. But after a run like this and nearly 1,000% rally, we have to execute the bear case. We have to look at the risks.
Okay, let's start with the elephant in the room. Valuation.
Right.
A price-to-earnings ratio of 12,211. I mean, that's a giant neon warning sign. It feels like driving at 200 miles an hour, any little bump, a small earnings miss, and the whole thing could fly apart. How do you defend that?
Look, that PE is undeniably a high hurdle. There's no getting around it. And it means the company has to deliver quarter after quarter.
So what's the defense?
The defense is that for a company like this, undergoing this huge structural shift, a trailing PE is often misleading.
You have to look forward.
Exactly. You have to look at the forward sales multiple. The stock is still trading at 7 times sales, which is actually attractive compared to the sector average of 8.7x.
So the argument is that the E and PE is going to grow into that valuation very, very quickly.
Precisely. That strong Q2 guidance is the key. It suggests that high PE is going to compress rapidly as those earnings actually materialize.
Okay, what about execution risk? The memory industry is famous for its cycles. What happens if there's a downturn?
The cyclicality is a real risk, no doubt. But the counterpoint here is that the AI demand tailwind is just so powerful. It acts as a kind of structural floor under the business. The need for this kind of storage isn't just a cycle, it's accelerating.
And their margins give them a good buffer too, right?
Yeah, a very strong buffer. Gross margins are at 27.9%. They're protected because they are so specialized in NAND, so they can maintain that pricing power even if there are crunches elsewhere.
And we have to remind everyone the next big data point is coming up fast.
It is. The fiscal Q2 2026 report is due on January 29th.
Consensus EPS is at $3.18. So that's the moment of truth for validating that guidance and getting an update on the buy CS8 ramp.
So bringing all of this together, the incredible fundamentals, the strong technicals, and the very real valuation risks, let's get to the final investment thesis for you.
So what's the final score, and why should people still be paying attention after this massive run?
We assign a highly confident bullish score of 9 out of 10.
A 9 out of 10. Give us the elevator pitch one last time. Why so bullish?
It's a pure play leader, dominating a critical space needed for AI data centers. It's proven its strength with that 22.6% revenue growth and the huge 58% EPS surprise.
And it benefits from the rest of the industry's problem.
Right. It benefits from the memory shortage that its rivals are, in a way, fueling. It's just the right company with the right tech at the exact right time.
And the institutional money is confirming that conviction. They see those high analyst targets as achievable, which means that 50+% upside we talked about is a real possibility.
This is a multi-year hold targeting the long AI cycle, assuming you can handle the volatility.
But there's also a shorter-term play.
Yeah, a strong swing trade potential leading right into that January 29th earnings report. We expect more bullish confirmation there.
All right, here's a final provocative thought for you to chew on. With that dizzyingly high 12,211 PE ratio, the entire long-term story here comes down to one question.
Which is?
Can their buy CS8 technology deliver the kind of consistent, high-margin cash flow growth that actually validates trading at 7x sales? That's the bet you're making.
We hope this analysis was helpful for your research. Don't forget to subscribe, like, and comment to support Investing Talk podcast, and we'll catch you next time.